When a sudden cash crunch hits your operations, the pressure to find immediate funding can feel overwhelming. You might be staring down a broken piece of critical equipment, an unexpected tax bill, or a sudden opportunity to buy inventory at a steep discount. In these high-stress moments, a merchant cash advance often appears on your radar as a fast, frictionless lifeline. The promise of rapid approval and funds deposited within 24 hours is incredibly seductive when traditional banking channels demand weeks of paperwork. But beneath that appealing facade of speed and accessibility lies a financial structure that can quietly erode your profitability. A merchant cash advance, or MCA, is not actually a loan in the traditional sense. Instead, it is a commercial transaction where a funding company purchases a percentage of your future credit card sales or daily bank deposits at a discount. They hand you a lump sum today, and in exchange, you agree to let them automatically siphon off a fixed percentage of your daily or weekly revenue until the advance, plus a hefty premium, is paid in full. This structure bypasses many of the stringent regulations that govern standard lending, creating an environment where the true cost of capital is easily obscured. The most deceptive element of an MCA is how the cost is presented to you. Instead of an interest rate, MCA providers use a factor rate, typically ranging from 1.1 to 1.5. If you receive an advance of $100,000 with a factor rate of 1.3, you are obligated to repay $130,000. While a 30% markup might sound manageable over a few years, these advances are usually designed to be recouped in a matter of months. This rapid repayment schedule dramatically inflates the true cost of the money you borrowed. To understand the real financial weight of that transaction, you have to translate it into an APR, which stands for annual percentage rate. APR is simply the standard measure of how much it costs to borrow money over a full year, including all associated fees. When you convert a typical merchant cash advance into an APR, the numbers can be staggering, frequently soaring well into the triple digits. Paying an effective APR of 80, 100, or even 200% acts as an anchor on your business growth, draining resources that should be reinvested into your team or your products. The daily or weekly repayment structure is where the hidden dangers truly begin to manifest in your day-to-day operations. Because the provider takes a fixed percentage of your sales right off the top, your cash flow is immediately and consistently reduced. On days when your revenue is high, they take a larger absolute dollar amount, and on slower days, the relentless deductions continue to eat into your remaining operating funds. This constant drain can make it incredibly difficult to cover fixed expenses like payroll, rent, and vendor payments. This severe cash flow squeeze is precisely what pushes so many well-intentioned business owners into a devastating debt cycle. When the daily deductions from the first advance leave you short on working capital to run the business, the temptation to take out a second advance just to stay afloat becomes immense. Working capital is simply the money you have available to meet your current short-term obligations and keep the lights on. Stacking multiple advances on top of one another rapidly accelerates the cash drain, turning a temporary financial patch into a permanent crisis. Escaping this high-interest trap requires shifting your focus toward more sustainable financing structures that align with your long-term health. A line of credit, for example, offers the flexibility you might have been seeking, but with significantly safer guardrails. Once approved, you have a set pool of funds you can draw from whenever necessary, and you only pay interest on the amount you actually use. This allows you to handle unexpected expenses or bridge temporary gaps without committing a percentage of your daily revenue to a third party. If your cash flow issues stem from waiting on clients to pay their bills, invoice factoring presents another highly effective alternative. This strategy involves selling your outstanding business-to-business invoices to a factoring company at a slight discount, giving you immediate access to the cash you have already earned. Because the factoring company relies on the creditworthiness of your clients rather than your own credit score, it can be an accessible way to accelerate cash flow without taking on new debt or daily revenue deductions. For more substantial capital needs, such as purchasing real estate, buying heavy equipment, or funding a major expansion, an SBA loan remains the gold standard. Backed by the Small Business Administration, these loans offer some of the lowest interest rates and longest repayment terms available on the market. While the application process demands meticulous preparation and time, the resulting financial stability is unmatched, allowing you to amortize the cost of growth over a decade or more rather than a few stressful months. Securing these superior funding options requires understanding what traditional lenders are actually evaluating when they review your application. They are primarily looking for proof that your business generates enough consistent profit to comfortably manage regular, predictable monthly payments. A key metric they use is EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. This is simply a measure of your company's core operational profitability, stripping away non-operating expenses to show exactly how much cash your business actually produces. Lenders will also heavily scrutinize your available collateral to mitigate their risk in the event of a default. Collateral is an asset of value, such as real estate, equipment, or inventory, that you pledge as security for a loan. If you fail to repay the debt, the lender has the legal right to seize that asset to recover their losses. Having strong collateral significantly increases your chances of securing favorable terms, as it provides a safety net that an unsecured merchant cash advance simply does not require. Moving away from the reactive panic that often leads to an MCA allows you to position your company for proactive strategic growth. When you secure financing with single-digit interest rates and predictable monthly payments, you unlock the ability to plan months and years into the future. That initial capital, once secured on fair terms, becomes the foundation for launching new product lines, expanding your geographic footprint, or hiring the executive talent needed to scale your operations to the next level. The line of credit's flexibility still proves vital as you navigate seasonal fluctuations or sudden market shifts. Instead of dreading a slow month because of relentless daily deductions, you can draw exactly what you need to bridge the gap and repay it when revenue naturally rebounds. This level of control transforms financing from a source of constant anxiety into a powerful tool for smoothing out the inevitable peaks and valleys of running a dynamic enterprise. In the broader economic landscape, the alternative lending market has exploded, heavily marketing high-speed, high-cost products to vulnerable entrepreneurs. While innovation in financial technology has certainly expanded access to capital, it has also placed the burden of due diligence squarely on your shoulders. Recognizing the difference between a strategic financial partner and a predatory funding source is a critical survival skill in today's fast-paced business environment. Protecting your hard-earned profit margins requires a disciplined approach to evaluating any funding offer that crosses your desk. You must demand absolute transparency regarding the total cost of capital, the effective annual percentage rate, and the exact mechanics of the repayment schedule. If a funding provider is evasive about converting their factor rate into a standardized metric, or if they pressure you to sign documents before you fully understand the terms, that is a glaring signal to walk away. The narrative that small businesses have no choice but to accept exorbitant rates simply because they lack perfect credit or extensive operating history is a damaging myth. There are community development financial institutions, local credit unions, and specialized online lenders dedicated to providing fair, transparent capital to growing enterprises. By organizing your financial records, understanding your cash flow cycles, and building a strong narrative around your business model, you make yourself an attractive candidate to these responsible lending partners. Consider the transformation of a manufacturing firm that finally broke free from the crippling grip of stacked cash advances. By working with a dedicated advisor, they consolidated their high-interest obligations into a single manageable term loan secured by their newly appraised equipment. The immediate cessation of daily revenue deductions breathed life back into their operations, instantly improving their cash position and allowing them to finally negotiate better pricing with their raw material suppliers. The echoes of those early financial decisions still resonate as that manufacturer now plans for international expansion. Their strong credit profile is no longer just a number. It is a testament to sound business practices and a key asset in their growth strategy. They understand that the cost of capital directly impacts their ability to compete, price their products aggressively, and weather unforeseen economic downturns without sacrificing their equity or operational control. Does this mean a merchant cash advance is universally evil and should never be considered under any circumstances? In extremely rare, hyper-specific scenarios, the speed of an advance might justify the exorbitant cost. If you have a guaranteed, highly profitable contract in hand, but need immediate cash to fulfill it, and you know with absolute certainty that the advance will be paid off in a matter of weeks from that specific revenue, it could technically make mathematical sense. However, that incredibly narrow window of utility is where most business owners miscalculate their risk. An MCA should never be used to cover ongoing operational shortfalls, payroll deficits, or general working capital needs. Using a product designed for short-term, high-margin opportunities to plug a structural leak in your business model is a guaranteed path to financial distress. It treats the symptom of poor cash flow while actively worsening the underlying disease. Your ultimate goal should be building a balance sheet so resilient that the panic-inducing need for 24-hour funding never arises. This requires rigorous financial forecasting, maintaining an emergency cash reserve, and establishing banking relationships long before you actually need to borrow a single dime. When you treat capital acquisition as a deliberate ongoing strategy rather than an emergency response, you reclaim control over your company's destiny. Bright side. Capital exists to illuminate these pathways, ensuring you never have to navigate the murky waters of business financing alone. We believe that every ambitious entrepreneur deserves access to clear, actionable insights that demystify the underwriting process and expose the hidden traps of predatory lending. By arming yourself with knowledge, you transform complex financial landscapes into navigable paths towards sustainable growth and long-term prosperity. The first step towards securing your financial future is taking an honest, unflinching look at your current capital structure. Evaluate any existing debt, calculate your true cost of capital, and identify exactly where your cash flow is being restricted. If you are currently trapped in a high-interest cycle, prioritize refinancing strategies that can consolidate those obligations into a single, predictable monthly payment that aligns with your actual revenue generation. Next, begin exploring the safer, more sustainable funding options we have discussed, even if you do not need the money today. Open a dialogue with a commercial banker about a line of credit, research factoring companies that specialize in your industry, or start gathering the documentation required for a future SBA application. Preparation is the ultimate antidote to the desperation that makes a merchant cash advance seem appealing. You have poured your blood, sweat, and tears into building your enterprise, and you deserve financing that fuels your ambition rather than draining your resources. It is time to step out of the shadows of high-cost debt and into the light of strategic, empowering capital management. If you want to see what your business qualifies for, complete the quick Brightside quiz, https Brightside Capital, IO Business Survey. It only takes 2 minutes, and it's a simple way to start reviewing your funding options.